Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
You probably think you understand how credit cards work. You spend a little here, a little there, pay it off later, maybe collect some points along the way. Simple, right? A modern convenience. A harmless plastic tool sitting in your wallet. But what if I told you that every swipe, no matter how small, is feeding something much bigger? Something older than the cards themselves. Something specifically designed to grow whether you're struggling, thriving, or even completely unaware. What if I told you that credit cards are not just products but pipelines? Pipelines into a financial empire you can't see but absolutely feel. An empire that expands quietly with every transaction you make, harvesting data, interest, fees, and patterns turning your very behavior into profit. And here is the twist most people never consider. This empire wasn't created by one bank, one company, or even one country. It grew from a series of decisions, mistakes, experiments, even accidents that started almost a century ago. A chain reaction of cause and effect that now shapes not just how we spend money, but how we think about money. Tonight, we unravel how credit cards became the fuel for a shadow financial system that touches your life every single day. A system hiding in plain sight. Because to understand how we got here, we need to start before the word credit card even existed, back when the world was changing faster than anyone could control. It didn't start with banks. It didn't start with corporations. It started with trust, or more accurately, with the breakdown of trust. In the early 20th century, as cities exploded in size and people moved faster than communities could adapt, local shopkeepers faced a problem they'd never seen before. Customers wanted to buy now and pay later, but nobody knew anyone anymore. Small stores started keeping handwritten tabs, ledger notes. I owe us. It worked until it didn't. People moved, disappeared, fell on hard times. Shopkeepers lost money. That is when a new idea began to form, an idea that would eventually evolve into the modern credit system. Not based on personal relationships, but on centralized control. A business, not a favor. A system of verifying who you were and whether you could be trusted with borrowed money. The early versions were clumsy. Metal plates, paper cards, little tokens. Not designed for convenience, but for identification. But the system was growing, spreading, and strengthening its grip. And at the center of this system were companies that realized something profound. If you could control trust, you could control money. If you could control money, you could control behavior. And if you could control behavior, you could build an empire. Fast forward to 1950. New York City. A man named Frank McNamara forgets his wallet at a restaurant, an embarrassing little mistake. But this single moment sparks a revolution. He imagines a card that lets people pay later, without cash, eliminating humiliation and adding a new layer of freedom. He launches the Diners Club card, a cardboard card at first, allowing members to charge restaurant bills. No interest, just a monthly fee. But this wasn't just a product. It was the proof of a concept, that people would willingly tie themselves to a system that monitored their spending, tracked their habits, and demanded repayment under strict terms. Other businesses noticed. Banks noticed. And when banks notice something profitable, they don't copy it, they amplify it. By the 1960s, Bank of America introduces the Bank Americard, the ancestor of Visa. Unlike Diners Club, this one charged interest, and interest wasn't just a fee, it was a doorway, a way to turn millions of small consumer decisions into unstoppable streams of revenue. Credit cards were no longer about convenience. They were machines for compounding profit. But something else was happening beneath the surface. Something nobody paid attention to at the time. Data. Every transaction told a story: what you bought, when, where, how often, how much. It painted a picture of who you were, what you valued, what tempted you, and what controlled you. Banks realized they weren't just lending money, they were collecting information, and information, especially in the financial world, is power. The story of credit cards becomes even darker when we reach the late 1970s. A single legal decision changed everything. A Supreme Court ruling Marquette National Bank v. First of Omaha allowed banks to charge interest rates according to the laws of their home state, not the borrower's state. What followed was predictable. Banks migrated to states with the loosed rules, creating modern financial havens within the U.S. Suddenly, there were no national limits on interest rates. Usury law's centuries-old protections were effectively erased, and the empire began to expand at hyperspeed. Credit cards became irresistible. Advertisements screamed freedom, status, convenience, security. Banks mailed cards to millions of people who never asked for them. People who didn't qualify, people with unstable income, people who could barely afford to live, let alone borrow. But it didn't matter, because banks didn't need everyone to repay on time. They needed enough people to carry a balance. And once enough people were trapped in the cycle of rolling debt, the empire became self-sustaining. This is where the chain reaction truly begins. Every dollar of revolving debt generates interest. Every interest payment increases profits. Every profit justifies expanding limits, creating new fees, targeting new groups. Each new group means more risk. More risk leads to higher interest. Higher interest creates more debt. More debt fuels the empire, and the cycle feeds itself like a living organism. Then came the 1990s and early 2000s, what insiders now call the golden age of credit expansion. If you were alive then, you probably remember getting credit card offers stuffed into your mailbox every week. 0% APR. No annual fee, cash rewards, free gifts, unlimited points. It all felt exciting. It felt generous, but it wasn't generosity. It was engineering, psychological engineering. The credit industry had mastered behavioral science long before consumers realized. They were being studied. They learned that if your credit limit increased, you'd spend more. If your card felt premium, you'd treat yourself more often. If you earned points, you'd swipe even when cash was in your pocket. If a payment was too easy, you'd think less and buy more. The empire wasn't just observing you anymore. It was shaping you. And then came the breaking point. The financial crisis of 2008. Most people think the collapse was about mortgages, housing, banks being reckless. But buried beneath it all was a simple truth. The same forces that created mass mortgage debt had already been perfected through decades of credit card lending. The patterns were identical: extend credit, remove guardrails, harvest profits. Let the system grow until it can't sustain itself. Millions lost homes. Banks were rescued by governments. The economy fell to its knees. And credit card companies, they tightened some rules for a while, but only on the surface, because the empire didn't fall in 2008. It adapted. New laws forced companies to be more transparent, but transparency didn't reduce profit. It just changed the strategy. Instead of hiding fees, companies invented new ones. Instead of lowering interest, they widened the gap between high-risk and low-risk borrowers. Instead of reducing debt, they created more tiers, more products, more cards, more incentives. And consumers, we adapted to, but not in the way you'd expect. After the crisis, wages stagnated while living costs climbed faster than ever. Housing, healthcare, food, transportation, everything got more expensive. People needed credit just to stay afloat. What used to be a convenience became a lifeline. By 2024, Americans alone owed over $1 trillion in credit card debt, more than at any point in history. Not because people were irresponsible, not because people were shopping for luxury items, but because credit cards became woven into survival, not indulgence. And this is where the unseen empire reaches its most powerful form. Today, when you swipe a card, for major things happen, none of which you see. The bank earns interest, the merchant pays a fee, the network collects a toll, and your data feeds algorithms that will influence your future choices. This is no longer a financial product. It is an ecosystem, an invisible economy that grows each time we participate in it. And that brings us to the part most people never think about. What happens when an empire grows? Quietly, invisibly, continuously, for decades. Patterns repeat. They always do. But the modern patterns are more shocking than anything in the past. Today, 6 out of 10 credit card users carry a balance month to month. The average interest rate is over 20%, sometimes 30% or more. Late fees quietly generate billions every year. Credit limits rise automatically, even when incomes don't. And the same people struggling with debt are hit with the highest interest rates, creating a wealth drain that moves upward through the economy. But there is another pattern, one even more alarming. Digital spending grows almost twice as fast when a physical card isn't involved. In other words, the less you touch your money, the more you lose track of it. And that makes the empire grow at exponential speed as the world moves toward mobile payments, tap to pay, virtual cards, and invisible loans embedded into apps. The original credit card system evolves into something far more powerful. Cards are becoming invisible, but the empire behind them is becoming impossible to ignore. So where does that leave us now? How do we break a cycle designed to thrive on our habits, our emotions, our impulses? How do we navigate a system built not to help us, but to use us gently, quietly, profitably? It starts with 3 realizations. First, convenience always comes with a cost. Anything that makes spending easier will make restraint harder. That's not a personal flaw, it's design. Second, interest is not the enemy. Ignorance is. When you understand how interest works, how it compounds, how small balances turn into large traps, you start seeing the system for what it truly is. Third, the empire isn't invincible. It depends on participation. Every conscious choice you make, every time you refuse unnecessary debt, every time you pay off a balance, every time you resist an upgrade you don't need, you shrink its power over you. But here's the warning you need to hear. This system is evolving faster than consumers are learning. And if history has taught us anything, it's that empires collapse when their complexity becomes unsustainable. When people can't keep up, when debt becomes the default. We are closer to that point than anyone wants to admit. The question is not whether the empire will grow. It will. The question is whether you choose to feed it or learn to navigate it with your eyes open. If you found this eye-opening, informative, or even slightly uncomfortable, that's a good sign. It means you're paying attention. And if you want to understand the deeper forces shaping your financial life, the systems behind debt, wealth, power, and the modern economy, make sure to like the video, subscribe, and check out the next story we're uncovering. This is just the beginning. The empire is bigger than credit cards, and much, much older. And once you understand where it came from, you'll never look at money the same way again.